Hello everyone. Today we will be starting with the topic of acquisition of business and accountancy, that is profit prior to incorporation. Means what we are going to study in this chapter is when a running business is acquired, okay? Maybe a joint stock company purchases a running partnership business. Maybe partnership gets converted into a private limited company or a joint stock company. So basically, a company is acquiring any sole proprietorship or partnership business which is already running in profits, which is already continuing in profits. At that time, how to find profit prior to incorporation? Because when a company acquires this existing running business, it will have to obtain the certificate of incorporation. It will have to register that business now under the company's name with registrar of companies. Okay, to get that certificate of incorporation, to obtain the certificate from the registrar of companies, it will take some time. So what profit is earned prior to incorporation and what is its relevance, how to compute it, we are going to study in this particular chapter. Okay, let's take up with the things in detail. First of all, let's understand what is profit prior to incorporation. See, very first, the company will acquire the running business as I explained you just now. After that, it will obtain the certificate of incorporation registration from the registrar of companies. Okay, incorporation means registration. And third, after that, it will obtain the certificate of commencement of business. You have studied this in the subject of business organization in past. To get certificate of incorporation, you have to submit memorandum of association and articles of association. To get certificate of commencement, you have to issue prospectus to the public. You have to register that prospectus with the registrar. So the procedure is first you acquire the running business, then you obtain certificate of incorporation, then you obtain certificate of commencement. Now what we are going to study is what is profit prior to incorporation. So as you can see in this photographs on the right side, in this images on the right side, prior to incorporation means, can I say acquiring the business till certificate of incorporation? We are not talking about after incorporation. So certificate of commencement has no relevance. I repeat, certificate of commencement has no relevance. Ignore it. Throughout this chapter, whatever certificate of commencement is given, ignore that, it has no relevance. We are just concerned with certificate of incorporation and profit prior to that incorporation. So whatever profit the business earns, the company earns from the date of acquiring the business till the date of getting the certificate of incorporation is called profit prior to incorporation. Now, since the company acquires the running business is always running, means it's already doing its activities of purchase and sales. So business is already earning the profit. But the company will get its identity or legal existence only once it gets the certificate of incorporation. Since you acquire a running business, profit you are earning, but in the name of that business, because your incorporation or registration is not done. So company is earning the profit, but company did not get its legal identity because incorporation is not done. So that profit is called profit prior to incorporation. Look at it. Profit earned by the company from the date of acquiring the business or the starting of the year to the day of incorporation is called profit prior to incorporation. Okay, from the date you acquire the business till the date you get it registered, company won't get its legal identity. So whatever profit you earn in that period of time, since you acquire a running business, you earn profit in that period also. That profit is called profit prior to incorporation. Here what did I tell you? Certificate of commencement of business is to be ignored. Just ignore the date of certificate of commencement throughout this chapter given in the question. Further, why should we find profit prior to incorporation? This will arise in your mind. Why to do all this nonsense? We are going to make profit and loss statement at the end of the year. Let us say the business is acquired on 1st April. Registration is done on 1st August. Then next year, 31st March, we are already going to make final accounts. Then why should we find profit prior to incorporation? We need to find it. You acquire the company on 1st April. Get it registered on 1st August. Means company gets its existence on 1st August only. Before 1st August, in the eyes of law, the company does not have any existence. Okay, before 1st August, until it is registered, in the eyes of law, company does not have any existence. Company is formed on 1st August. After that, only shareholders will be becoming the owners of the company. So what is the relevance? Why should we find the profit prior to incorporation? Because whatever profit company earns before incorporation is a capital profit in nature. I repeat, whatever profit company earns before incorporation is a capital profit in nature. That is supposed to be transferred to capital reserve, and company cannot declare dividend to shareholders from this because company itself did not have any existence at that point of time. So company actually has not earned any profits in its own name and it cannot give dividend to the shareholders. So why should we find profit prior to incorporation? Because that is capital profit in nature and to be transferred to capital reserve. You cannot give dividend from those profits. And in case if there is loss instead of profit, that will be debited to goodwill account. I repeat, before incorporation, if there is a profit, transfer to capital reserve. If there is a loss, debit to goodwill account. Okay? And dividend can be declared to shareholders from whatever profits company earned from 1st August onwards in the example I gave you. Means after incorporation, whatever profit company earns, from that it can give the dividend to shareholders. So, since the company does not get its legal existence until incorporation, profit earned prior to incorporation is a capital profit and is transferred to capital reserve. If there is loss, then it is debited to goodwill account. This profit cannot be used to give dividend to shareholders. Profit earned after incorporation is revenue profit in nature and is used to give dividend to shareholders. So this is the reason we find profit prior to incorporation. Okay, all of you give the heading in your notebooks. Okay, all of you give the heading in your notebooks, profit prior to incorporation, and note down this. Why should we find profit prior to incorporation? Pause the video and note down this. And also you can rewind the video and write down in the beginning what is profit prior to incorporation. Okay. In the previous slide what I explained you, that was the profit earned from the date of acquiring the business till the date of incorporation is called profit prior to incorporation. That you note down in your notebooks first. Then you pause the video and note down this. Why should we find profit prior to incorporation? Okay. Do it fast, everyone. I hope all of you have written this after pausing the video. Now understand it further. How to allocate the incomes and expenses to pre and post incorporation period. So pre-incorporation means that April to August period. Post incorporation period means after getting the registration August till the year end 31st March. So how will we allocate the incomes and expenses? Because we will be directly finding the incomes and expenses at the end of the year only when we make final accounts on 31st March. So how will you allocate and distribute it? That which are the first 4 months, April, May, June, July, profits, incomes and expenses, and which are remaining 8 months, August to March, incomes and expenses. We will be using 3 bases for that. To allocate incomes and expenses to pre and post incorporation period, following 3 bases are used. Time basis, sales basis, actual basis. Time basis means you simply allocate the expenses and incomes in the ratio, I repeat, in the ratio of time. Like I discussed just now, first 4 months, April, May, June, July, pre-period, August to March, 8 months post-period. So 4 months and 8 months, 4:8 is the time ratio. So whatever incomes and expenses go on time basis, 4 by 12, 4 months out of 12 months, 4 by 12 will go in pre-period, 8 by 12 will go in post-period. Same way, sales basis means whatever is your sales for the first 4 months, April, May, June, July, and whatever is your sales for the remaining 8 months, in that ratio, some incomes and expenses will be allocated. For example, discount allowed on sales will go on sales ratio. Advertisement expense will go on sales ratio. So that we will see in detail at the end of this lecture. But some incomes and expenses will go on time basis, 4 by 12, 8 by 12. Some incomes and expenses will go on sales basis, means in the ratio of sales of first 4 months to sales of last 8 months. Okay, 4 months and 8 months is just an example what I gave you. It can be any other period depending on the date of acquisition and date of incorporation. And actual basis means some incomes and expenses will come either only in pre-period or only in post-period. Okay, means for example, bad debts recovered on 1st of October. It cannot come in pre-period because they are recovered on 1st October, which is a part of post-acquisition period. Entire bad debts recovered will come in post-period only. Directors' remuneration. Company itself is formed on 1st August. So directors would become the directors of the company after 1st August only. So whatever remuneration you give to directors will be entirely taken in post-acquisition period only. These are called actual basis. Actual basis means the entire income or expense either belongs only to pre-acquisition period or entire income and expense entirely belongs only to post-acquisition period. Actual basis. For doing these three, we will be making these workings in our solution. All of you first write down in your notebook how to allocate the incomes and expenses to pre and post incorporation period. All of you write down in your notebook this entire slide. Pause the video and write it down. To allocate incomes and expenses to pre and post incorporation period, following three bases are used: time basis, sales basis, and actual basis. Every one of you must note it down. Now, what workings we will be making for this? Date of acquisition or year beginning. Okay, three dates you'll note down in the question: date of acquisition or year beginning, date of incorporation, and date of year ending. Ignore the date of commencement. As I said to you in the beginning of this lecture, ignore the date of commencement. So three dates we will note down in our solution: date of acquisition or the date of year beginning, date of incorporation, and date of year ending. Now whatever is the period or months from date of acquisition or year beginning to the date of incorporation is called pre-acquisition period, and whatever is the period from date of incorporation till the date of year ending is called post-acquisition period. Time basis means you'll see the months of pre and months of post and find the ratio. I repeat, time basis means you will see how many months are in pre, how many months are in post, and you'll find the ratio of those months. Okay, ratio of months will be time basis. Sales basis means you'll find the sales of pre-acquisition period and sales of post-acquisition period, and ratio of that sales will be sales basis. I repeat, in time basis, months of pre and post; in sales basis, sales amount of pre and post ratio is to be obtained. An actual basis doesn't have relevance with these workings. Actual means entirely is taken in pre or entirely is taken in post. So note down these workings in your notebook. What workings we will be making in every question in this chapter. Note it down: date of acquisition or year beginning, date of incorporation, date of year ending. And then below that, make a bracket and write date of year beginning to incorporation is pre-acquisition, date of incorporation to year ending is post-acquisition. Further, you may write down for time basis, we'll find the months of pre and post. For sales basis, we will find the sales of pre and post acquisition period. Further, now before we go ahead with the questions in this chapter, all of you need to understand the Proforma of profit and loss statement as per Companies Act 2013. All of you give this heading in your notebooks and you need to write this format of profit and loss statement, because companies P&L we are making, so we have to follow that format and you have to remember it also. I will be giving you a shortcut to remember the same also. But first, all of you note down in your notebook this format. Make 6 columns. Make 6 columns. Particulars, basis of allocation, this time sales and actual basis will be writing in the basis of allocation. Note number, will be making notes for each and every item of incomes and expenses in detail. Total amount, and then split into pre-incorporation period and post-incorporation period. Pause the video and make these columns. Particulars, basis of allocation, note number, total amount, pre-incorporation period amount, post-incorporation period amount. Pause the video and make these columns. I hope everyone has done the columns. Now understand the content of this P&L statement that you all need to note it down. It's a vertical format what we have to follow. Okay, and you have already studied this format in standard 12. In standard 12, company's final accounts, balance sheet and P&L statement format you have already studied. Okay, so you don't make debit and credit side. For companies, you make in vertical format. Very first, you note down the incomes. You can see first 2 items are of incomes. Which 2 items? First, revenue from operations. Write down in the notebook, everyone. Number 1, revenue from operations. In brackets, you can write. In bracket, you can write sales or gross profit. Okay, revenue from operation in bracket, write down. It will include either sales or directly the gross profit. Okay, sales or gross profit. Whatever amount of sales is given in the question or whatever amount of gross profit is given in our practical questions, we will include it in the note of revenue from operations. Okay, then note down second, other incomes. Other than sales, all other incomes will come in the category of 2 other incomes. Then third, total incomes. Now no shortcut is required for incomes because there are only 2 incomes. You can directly remember them. Revenue from operation and other incomes. Revenue from operation means your main operations of the business, that is sales or gross profit, and other incomes. So no shortcut for incomes. Only 2 items are there. Revenue from operations, other incomes, and then we get total incomes. Now expenses, all of you note down in the notebook. Cost of materials consumed. Cost of material consumed means raw material. If it's a manufacturing business, generally joint stock companies would be a manufacturing company. Then cost of material consumed means they buy the raw material and convert it into finished goods. So for them, cost of material consumed will include opening stock of raw material plus purchases of raw material minus closing stock of raw material. Just for your understanding, this chapter related practical questions, you won't have cost of material consumed. Write down, you have to write it in the format. Okay, don't skip that. In our solutions also we'll write it, but it will always remain nil. Because Companies Act 2013 format is to be followed. Each and everything is to be written even if it is not given in the question, and you have to write nil. So cost of material consumed. Okay, I repeat, for manufacturing companies, they buy raw materials and convert into finished goods. So cost of material consumed represents opening stock of raw material plus purchases minus closing stock. But you won't have it in your questions. I hope everyone has written that. Next, write down direct purchases of stock in trade. Now here you don't buy the raw materials, you directly buy the finished goods. That is called direct purchases of stock in trade. So if yours is not a manufacturing company but a trading company, you buy the goods at lesser price and you sell the goods at higher price, then you will have direct purchases of stock in trade. Then change in inventories. So if you don't have cost of raw materials consumed, you buy and sell finished goods, then you can have change in inventories, which is in bracket write down opening stock minus closing stock. But again, it will not be there in your practical question, so don't worry. However, what does change in inventories represent? You can write down opening stock minus closing stock. That will include opening stock minus closing stock of work in progress also and finished goods also. If you are having raw materials, then it can include opening and closing stock of work in progress as well as finished goods. And if you don't have raw materials, you directly buy and sell finished goods, then change in inventories will include only opening stock minus closing stock of finished goods. Then write down employee benefit expenses. All the amount of salaries, wages, contribution to provident fund. These three things will generally come in employees benefit expenses. I repeat, salaries, wages and contribution to provident fund will generally come in employees benefit expenses. Note it down, employees benefit expenses. In bracket, if you want, you can write, it will include salaries, wages and contribution to provident fund. Then write down finance cost. Finance cost in bracket, write interest. All the interest which the company pays, whether on loan borrowed, debentures issued by the company, public deposits issued by the company, all that interest amounts will come in finance cost. So in bracket, in capital letters, write interest. All the interest paid will come in finance cost. Then write depreciation and amortization expenses. Okay, you can pause the video wherever you feel the need and then you may note it down. Depreciation you all already understand. Amortization in bracket, write W/O, written off. Okay, we have goodwill written off, we have trademarks written off, we have preliminary expenses written off, underwriting commission written off, discount written off. All that will come in amortization expenses. So amortization means in bracket, write down W/O, written off. And then we have other expenses, which includes administrative, selling and miscellaneous expenses. Means when we make the note of other expenses, we will have three subcategories in that: administrative expenses, selling expenses and miscellaneous expenses. So in bracket of other expenses, write down administrative, selling and miscellaneous. Total of all these items, cost of material, direct purchase, change in inventories, employees benefit, finance, depreciation and amortization and other expenses will get total expenses. Fifth item, we will get profit before tax. That is 3 minus 4. Means 3 is total income, you all can see above, minus 4 is expenses. So total incomes minus expenses, we will get profit before tax. From that we will minus taxes, 6th item, and 7th we will get profit after tax. That is 5 minus 6. Okay, note it down everyone, pause the video and note down the entire format. Then I will give you a shortcut for the same. Yes, I hope everyone has noted down the format. Okay. Now what is the shortcut you will remember for this? Income, there are only 2 incomes, so no need to remember any shortcut for that. Only 2 incomes, revenue from operations and other incomes. But for expenses, you can remember the shortcut. Very simple, C, D, E, F, do. Okay, note down this in the notebook, C, D, E, F, do. What does this C stand for? Cost of material consumed. D, direct purchases of stock and trade. E, employees benefit expenses. F, finance cost. D, depreciation and amortization. O, other expenses. Now, change in inventories will also come for C, but as I said, generally you won't have it in your exams. In this chapter, cost of material consumed and change in inventories won't be given, but still in the format we will be writing it. So C, D, E, F, do. Note down this shortcut in the notebook. C stands for cost of material consumed and change in inventories. D stands for direct purchase of stock and trade. E, employees benefit. F, finance cost. D, depreciation and amortization. O, other expenses. So this is how you can remember the format of Companies Act 2013 profit and loss statement. In this format only we have to solve all the examples in this chapter. So without seeing, I repeat, without seeing, all of you must write this format once again in your notebook. You have to remember this format. So entire format, starting from revenue from operations till profit after tax. With the help of this shortcut, all of you write it one more time in your notebook without seeing. Make it sure that you learn this format. Now going further, basis of allocation. In this format of profit and loss statement what we have seen, and We have seen prior to that format, time basis, sales basis and actual basis. Now we understand, starting from revenue from operations till other expenses, which incomes and expenses will go on time basis, which ones will go on sales basis and which ones will go on actual basis. Look at it. Very first, revenue from operations. Note down this in your notebook, basis of allocation. Revenue from operation will always go on sales basis. Whether you have sales directly given or gross profit given, it will always be distributed in pre and post acquisition period on which ratio? Sales basis. Note it down in your notebook. Other incomes will generally go on time basis, okay, except discount received may go on purchase basis because discount you receive on purchase of goods, or sales basis if purchase basis is not given. So in bracket you can write discount received on purchase basis or sales basis. I repeat, other incomes write down generally time basis, and in bracket write down discount received on purchase basis or sales basis, except that all other incomes will generally go on time basis. Then in the expenses we had C, D, E, F, do, but I said to you C, cost of materials consumed you won't have. So D, direct purchases of stock and trade will either go on purchase basis or sales basis. So mostly purchase basis, but if purchase ratio is not given in the question, then we will distribute purchase of stock and trade also on sales basis. Then again I said to you, change in inventories you won't have in this chapter. So E, employees benefit expenses will go on time basis. Okay, all of you must be writing this in the notebook. Employees benefit expenses will always go on time basis. Finance cost. Now within finance cost, interest on debentures will go on actual basis, and in bracket always post. In actual also, entire amount in post acquisition period. Why? Debentures can be issued only after the company is registered and gets the legal identity. So debentures interest is never possible in pre-incorporation period. Whatever interest on debentures is given in the P&L statement, entire amount they will always take on actual basis in the post-acquisition column only. Interest payable to the vendor. Now, the person from whom you have purchased the business, you may pay him the money in installments, EMI or later on. So suppose you acquired the business on 1st April, but you pay him the money by 31st December. Then he will charge you interest from April to December. This interest payable to vendor will go on time basis until the date of repayment. Don't find till March. You are repaying the money on 31st December. So April to December, April, May, June, July. In our example, what I gave you, 1st August incorporation period. April, May, June, July, 4 months interest will go to pre-period. August, September, October, November, December. Okay, August onwards. April, May, June, July, 4 months pre, and August, September, October, November, December. 5 months amount will go in post acquisition period if you repay the money on 31st December. You will be more clear once we take up with the examples, but note down this in your notebook. Interest on debentures will go on actual basis always in post acquisition period. Interest payable to vendor will go on time basis, but time basis also not till March. Time basis till the date of repayment. Whatever ratio is of time basis of pre-acquisition period and post-acquisition period only till the date of repayment, that many months ratio we will distribute interest payable to vendor. Okay, write down this in the notebook. Wherever required, pause the video. Depreciation and amortization. Depreciation will always go on time basis because you provide depreciation for a full year at the end of the year. So first 4 months depreciation pre-acquisition and remaining 8 months depreciation post-acquisition period. However, writing off of preliminary expenses will go on actual basis always post. Preliminary expenses means formation expenses of company. They come into existence only after the company is formed. So if preliminary expenses are written off, then it will always go in post-acquisition column only. Actual basis in post-acquisition column only. And other expenses, C, D, E, F, do. D, depreciation, amortization, O, other expenses. Within other expenses, administrative expenses will generally go on time basis, but in bracket write down, however, director's remuneration on actual basis post. This I discussed earlier also, directors become the directors of the company only after the company is registered. So whatever remuneration you pay to the directors will always go in post incorporation period only. Other administrative expenses will generally go on time basis. Selling expenses will generally go on sales basis because they are selling expenses. And miscellaneous expenses can go on any basis. They may go on time basis or sales basis or actual basis depending on the expense nature. That we will see and understand in the practical questions which will go on which particular basis. Okay. So all these points, all of you go through them thoroughly well. In the next lecture, we will start with the practical questions. But before we start with the practical questions, two things you need to understand. Number one, profit and loss statement of Companies Act 2013 you need to remember properly. Two incomes, revenue from operation and other incomes, and C, D, E, F do. Second, basis of allocation, which incomes and expenses will go on time basis, which ones will go on sales basis, and which one will go on actual basis. So all these things note down in your notebooks thoroughly well, and I will be asking it to you in the live session we will have in the next lecture. So prepare thoroughly well with profit and loss statement format and basis of allocation also. Next lecture we will start with the practical questions. Till then, bye everyone. Take care. See you in the next lecture.